I think what we had been seeing is a real fear that earnings were going to be weaker than expected and that guidance would be particularly weak. So by the time we got to December 24th and the market was down about 20%, it seemed clear that a lot of investors thought that we were either entering a recession or maybe we were even in a recession. So once we hear that earnings are up 14%, 15%, they haven't been bad. They're not, maybe perhaps not stellar, but not bad. And there's some growth for this coming year. I think that's a relief. I think the reason that you've seen a number of the industrials and the financials and energy stocks up so far is because what we've heard from financials and industrials has been relatively good. It really took the laggards from last year, and they've been up 8 to 9% as sectors so far this year. And that, I think, is a little surprising to many investors.
Kari, we've seen quite a lot of differentiation this earnings season, some stocks jumping, some crashing after they've reported numbers. What about when it comes to Apple? Is that going to be a stock-specific move tonight, or because it's so big, can it affect the whole market, as it did in January when it pre-warned on what to expect? Earlier in January, still in Jan.
So that's a very good question. And the market, of course, is looking to Apple. But as we know, Apple is up 1% since the day that they gave those, very weak guidance news. And we have heard from Starbucks, for example, and we have heard from a couple of other companies in China that gave reasonably good numbers about the Chinese consumer. So while the chip companies have been weak, there's a suggestion that the government stimulus has been doing a job in improving the sort of sentiment and the spending patterns of the Chinese, population. And I think we'll hear more about that. Of course, it's a big player. It's, an enormous market cap. And if it has a bad outlook, worse than expected, and of course, they've already given a sense of how bad it was going to be. But if it's worse than that, I would think that the market will be down tomorrow. But, hopefully they covered that in the last call a few weeks ago.
And of course, Rick, we have no dearth of market-moving news this week. The Fed also kicking off its two-day meeting today. We get that press conference and that decision tomorrow. Right now, ahead of that, Treasury yields are largely lower. What's the bond market signaling in terms of expectations from the Fed chair tomorrow?
I think by the fact that it is hunkering down, real compression within the amount of basis points of closing ranges over the last 14 to 15 sessions. And I think that speaks quite directly to the idea that the Fed most likely is on pause. We could debate if the rate at which we pause is the neutral rate or is close to the neutral rate. But I do think that tomorrow, although no surprises, I, like many, will look forward to any more detail regarding the balance sheet. And I would like to draw a line from the balance sheet to the dollar index and the foreign exchange relationships. If indeed that form of tightening, quantitative tightening, balance sheet drain, if that slows, or if there is a notion that we can see the light at the end of the tunnel of it leveling off, and that is quantified directly through either statements or press conference, most likely the dollar will continue to drift. Think about it this way: loosening up the grip on capital a bit, it should alleviate some of the pressures around the globe where dollars are a little bit more scarce, emerging markets. And I think by watching the dollar index, especially in the afternoon during Fed watch time in the press conference, we should be able to see that dynamic in place.